Fractional reserve banking is the practice whereby a bank accepts deposits, makes loans or investments, and holds reserves that are equivalent to a fraction of its deposit liabilities. Reserves are held at the bank as currency, or as deposits in the bank's accounts at the central bank. Fractional reserve banking is the current form of banking practiced in most countries worldwide. Fractional reserve banking allows banks to act as financial intermediaries between borrowers and savers, and to provide longer-term loans to borrowers while providing immediate liquidity to depositors. However, a bank can experience a bank run if depositors wish to withdraw more funds than the reserves held by the bank. To mitigate the risks of bank runs and systemic crises, governments of most countries regulate and oversee commercial banks, provide deposit insurance and act as lender of last resort to commercial banks, because bank deposits are usually considered money in their own right, and because banks hold reserves that are less than the deposit liabilities. Fractional reserve banking permits the money supply to grow beyond the amount of the underlying reserves of base money originally created by the central bank. In most countries, the central bank regulates bank credit creation, imposing reserve requirements and capital adequacy ratios. This can limit the amount of money creation that occurs in the commercial banking system, and helps to ensure that banks are solvent and have enough funds to meet demand for withdrawals. However, rather than directly controlling the money supply, central banks usually pursue an interest rate target to control inflation and bank issuance of credit. History. Fractional reserve banking predates the existence of governmental monetary authorities and originated many centuries ago in bankers' realization that generally not all depositors demand payment at the same time. In the past, savers looking to keep the coins and valuables in safekeeping depositories deposited gold and silver at goldsmiths, receiving in exchange a note for the deposit. These notes gained acceptance as a medium of exchange for commercial transactions and thus became an early form of circulating paper money. As the notes were used directly in trade, the goldsmiths observed that people would not usually redeem all the notes at the same time, and they saw the opportunity to invest their coin reserves in interest-bearing loans and bills. This generated income for the goldsmiths but left them with more notes on issue than reserves with which to pay them. A process was started that altered the role of the goldsmiths from passive guardians of bullion, charging fees for safe storage, to interest-paying and interest-earning banks. Thus, fractional reserve banking was born. If creditors lost faith in the ability of a bank to pay the notes, however, many would try to redeem the notes at the same time. If, in response, a bank could not raise enough funds by calling in loans or selling bills, the bank would either go into insolvency or default on its notes. Such a situation is called the bank run and caused the demise of many early banks. The Swedish Riksbank was the world's first central bank, created in 1668. Many nations followed suit in the late 1600s to establish central banks which were given the legal power to set the reserve requirement, and to specify the form in which such assets are required to be held. In order to mitigate the impact of bank failures and financial crises, central banks were also granted the authority to centralize banks' storage of precious metal reserves, thereby facilitating transfer of gold in the event of bank runs, to regulate commercial banks, impose reserve requirements, and to act as lender of last resort if any bank faced a bank run. The emergence of central banks reduced the risk of bank runs which is inherent in fractional reserve banking. and it allowed the practice to continue as it does today. During the 20th century, the role of the central bank grew to include influencing and managing various macroeconomic policy variables, including measures of inflation, unemployment, and the international balance of payments. In the course of enacting such policy, central banks have from time to time attempted to manage interest rates, reserve requirements, and various measures of the money supply and monetary base. Regulatory framework. In most legal systems, a bank deposit is not a bailment. In other words, the funds deposited are no longer the property of the customer. The funds become the property of the bank, and the customer in turn receives an asset called a deposit account. That deposit account is a liability on the balance sheet of the bank. Each bank is legally authorized to issue credit up to a specified multiple of its reserves. See reserves available to satisfy payment of deposit liabilities are less than the total amount which the bank is obligated to pay in satisfaction of demand deposits. Fractional reserve banking ordinarily functions smoothly. Relatively few depositors demand payment at any given time, and banks maintain a buffer of reserves to cover depositors' cash withdrawals and other demands for funds. However, during a bank run or a generalized financial crisis, demands for withdrawal can exceed the bank's funding buffer, and the bank will be forced to raise additional reserves to avoid defaulting on its obligations. A bank can raise funds from additional borrowings by selling assets, or by calling in short-term loans. If creditors are afraid that the bank is running out of reserves or is insolvent, they have an incentive to redeem the deposits as soon as possible before other depositors access the remaining reserves. Thus, the fear of a bank run can actually precipitate the crisis. Many of the practices of contemporary bank regulation and central banking, including centralized clearing of payments, central bank lending to member banks, regulatory auditing, and government-administered deposit insurance, are designed to prevent the occurrence of such bank runs. Economic function. Fractional reserve banking allows banks to create credit in the form of bank deposits which represent immediate liquidity to depositors. The banks also provide longer-term loans to borrowers, and act as financial intermediaries for those funds. Less liquid forms of deposit or riskier classes of financial assets may lock up a depositor's wealth for a period of time, making it unavailable for use on demand. This borrowing short, lending long, or maturity transformation function of fractional reserve banking is a role that many economists consider to be an important function of the commercial banking system. Additionally, according to macroeconomic theory, a well-regulated fractional reserve bank system also benefits the economy by providing regulators with powerful tools for influencing the money supply and interest rates. Many economists believe that these should be adjusted by the government to promote macroeconomic stability. The process of fractional reserve banking expands the money supply of the economy but also increases the risk that a bank cannot meet its depositor withdrawals. Modern central banking allows banks to practice fractional reserve banking with interbank business transactions with a reduced risk of bankruptcy. Money supplies around the world. In countries where fractional reserve banking is prevalent, commercial bank money usually forms the majority of the money supply. The acceptance and value of commercial bank money is based on the fact that it can be exchanged freely at a commercial bank for central bank money. The actual increase in the money supply through this process may be low, as banks may choose to hold reserves in excess of the statutory minimum. Borrowers issuers may let some funds sit idle, and some members of the public may choose to hold cash. And there also may be delays or frictions in the lending process. Government regulations may also be used to limit the money creation process by preventing banks from giving out loans even though the reserve requirements have been fulfilled. Regulation. Because the nature of fractional reserve banking involves the possibility of bank runs, central banks have been created throughout the world to address these problems. Central banks' government controls and bank regulations related to fractional reserve banking have generally been used to impose restrictive requirements on note issue and deposit taking on the one hand, and to provide relief from bankruptcy and creditor claims, and or protect creditors with government funds when banks defaulted on the other hand. Such measures have included minimum required reserve ratios, minimum capital ratios, government bond deposit requirements for note issue, 100% marginal reserve requirements for note issue, such as the Bank Charter Act 1844, sanction on bank defaults and protection from creditors for many months or even years, and central bank support for distressed banks, and government guarantee funds for notes and deposits, both to counteract bank runs and to protect bank creditors. Reserve requirements. The currently prevailing view of reserve requirements is that they are intended to prevent banks from generating too much money by making too many loans against the narrow money deposit base, having a shortage of cash when large deposits are withdrawn. In some jurisdictions, the central bank does not require reserves to be held during the day. Reserve requirements are intended to ensure that the banks have sufficient supplies of highly liquid assets, so that the system operates in an orderly fashion and maintains public confidence. In addition to reserve requirements, there are other required financial ratios that affect the amount of loans that a bank can fund. The capital requirement ratio is perhaps the most important of these other required ratios. When there are no mandatory reserve requirements, which are considered by some economists to restrict lending, the capital requirement ratio acts to prevent an infinite amount of bank lending. Liquidity and capital management. For a bank to avoid defaulting on its obligations, the bank must maintain a minimal reserve ratio that it fixes in accordance with, notably, regulations and its liabilities. In practice, this means that the bank sets a reserve ratio target and responds when the actual ratio falls below the target. Such response can be, for instance, selling or redeeming other assets, or securitization of illiquid assets, restricting investment in new loans, borrowing funds, issuing additional capital instruments, or reducing dividends. Because different funding options have different costs and differ in reliability, banks maintain a stock of low-cost and reliable sources of liquidity such as demand deposits with other banks, high-quality marketable debt securities, committed lines of credit with other banks. As with reserves, other sources of liquidity are managed with targets. The ability of the bank to borrow money reliably and economically is crucial, which is why confidence in the bank's creditworthiness is important to its liquidity. This means that the bank needs to maintain adequate capitalization and to effectively control its exposures to risk in order to continue its operations. If creditors doubt the bank's assets are worth more than its liabilities, all demand creditors have an incentive to demand payment immediately, causing a bank run to occur. Contemporary bank management methods for liquidity are based on maturity analysis of all the bank's assets and liabilities. Assets and liabilities are put into residual contractual maturity buckets such as on demand, less than 1 month, month, 2 to 3 months, etc. These residual contractual maturities may be adjusted to account for expected counterparty behavior such as early loan repayments due to borrowers, refinancing and expected renewals of term deposits to give forecast cash flows. This analysis highlights any large future net outflows of cash and enables the bank to respond before they occur. Scenario analysis may also be conducted, depicting scenarios including stress scenarios such as a bank-specific crisis. Hypothetical example of a bank balance sheet and financial ratios. An example of fractional reserve banking and the calculation of the reserve ratio is shown in the balance sheet below. In this example, the cash reserves held by the bank is $3,010 million and the demand deposits of the bank are $25,482 million, for a cash reserve ratio of 11.81%. Other financial ratios. The key financial ratio used to analyze fractional reserve banks is the cash reserve ratio, which is the ratio of cash reserves to demand deposits. However, other important financial ratios are also used to analyze the bank's liquidity, financial strength, profitability, etc. For example, the ANZ National Bank Limited balance sheet above gives the following financial ratios. The cash reserve ratio is $3,010 million per $25,482 million, i.e. 11.81%. The liquid assets reserve ratio is $25,482 million, i.e. 18.86%. The equity capital ratio is $8,703 million per 107,787 meters, i.e. 8.07%. The tangible equity ratio is 107,787 meters, i.e. 5.02%. The total capital ratio is $107,787 million, i.e. 9.99%. It is important how the term reserves is defined for calculating the reserve ratio, as different definitions give different results. Other important financial ratios may require analysis of disclosures in other parts of the bank's financial statements. In particular, for liquidity risk, disclosures are incorporated into a note to the financial statements that provides maturity analysis of the bank's assets and liabilities and an explanation of how the bank manages its liquidity. Criticisms of textbook descriptions of the monetary system. Sir Mervyn King, former governor of the Bank of England, said, "Textbooks assume that money is exogenous. In the United Kingdom, money is endogenous." Glenn Stevens, governor of the Reserve Bank of Australia, said of the money multiplier, "Most practitioners find it to be a pretty unsatisfactory description of how the monetary and credit system actually works." Lord Adair Turner, formerly the UK's chief financial regulator, said, "Banks do not, as too many textbooks still suggest, take deposits of existing money from savers and lend it out to borrowers. They create credit and money ex nihilo, extending a loan to the borrower and simultaneously crediting the borrower's money account." Maclay et al. Said in the Bank of England Quarterly Bulletin, "This description of the relationship between monetary policy and money differs from the description in many introductory textbooks, where central banks determine the quantity of broad money via a money multiplier by actively varying the quantity of reserves." Former Deputy Governor of the Bank of Canada William White said, "Some decades ago, the academic literature would have emphasized the importance of the reserves supplied by the central bank to the banking system. and the implications for the growth of money and credit. Today, it is more broadly understood that no industrial country conducts policy in this way under normal circumstances. Quote, in 2014, the Icelandic MP Frosti Sigurjónsson delivered his report, A Better Monetary System for Iceland, to the Icelandic Prime Minister. In this report, he claims that the central bank is not in control of money creation. He suggests a sovereign money system as an alternative to the existing fractional reserve system. This would include a committee that is independent of the government and works transparently, would make a decision on whether and when to create money. Criticisms of fractional reserve banking. In 1935, economist Irving Fisher proposed a system of 100% reserve banking as a means of reversing the deflation of the Great Depression. He wrote, 100% banking would give the Federal Reserve absolute control over the money supply. Recall that under the present fractional reserve system of depository institutions, the money supply is determined in the short run by such non-policy variables as the currency deposit ratio of the public and the excess reserve ratio of depository institutions. Austrian school economists such as Jesus Huerta de Soto and Murray Rothbard have also strongly criticized fractional reserve banking, calling for it to be outlawed and criminalized. According to them, not only does money creation cause macroeconomic instability, but it is a form of embezzlement of financial fraud, legalized only due to the influence of powerful rich bankers on corrupt governments around the world. Politician Ron Paul has also criticized fractional reserve banking based on Austrian school arguments. The UK-based organisation Positive Money has been campaigning since 2010 against fractional reserve banking. Under the organisation's proposal, money creation would be done exclusively by central banks. The organisation claims that instead of going into property bubbles or financial market speculation, new money would be used to finance public investment or even distributed directly to every citizen.